All right, here we go. Got the recording going. Welcome everyone to the Mailbox Money Masterclass. I see a lot of new faces. I do see some familiar faces as well. Many of you I have spoken to at some point in the past. Many of you I look forward to speaking with. In the future, I see we've even got a few mastermind members here on the meeting today, which is awesome. It's always super, super helpful to review the foundations. And that is what we are going to be going over today in the Mailbox Money Masterclass is the foundational strategies as well as the foundational tactics that we utilize inside of the mastermind in order to multiply the returns that we are achieving in the cryptocurrency market. So, with that said, let's dig right in. I'm going to share my screen. And I see we got some comments in the chat going. That's always awesome. As you guys have questions or thoughts as we go, feel free to drop those in the chat. And then at more towards the end, we'll get into some Q&A. I'll be addressing some specific questions that you all have, and we can take it from there. So let me share my screen. There we go. You should be looking at my big, beautiful, empty whiteboard here. So, first of all, let's just get this out of the way really quick. I want to talk a little bit about what this is not. Simply because when I speak with people that are considering joining the mastermind or just want to talk crypto in general, it's kind of like, well, what do you guys do? What's so different about it? So just real quickly, what it's not. This is not crypto mining. All right. This is not day trading. This is not meme coin hunting, right? So this is all the kitty doggy froggy coins, that kind of stuff. And this is definitely not leveraged trading or options or anything of that sort. I can fully acknowledge that these are ways to make money in the cryptocurrency market. However, it's not what we do. Why is that? And to more of the point, what is this exactly? In my opinion, this is the most hedged approach. What do I mean by hedged? Simply put, this is a way to balance how much time you're putting into this whole process. It's a way to balance out a very low risk strategy, and it's a way to account for multiple possibilities. Okay. What do I mean by that? Well, in the short term, we don't know what's going to happen in terms of the price action in the crypto market. People tell you they know what's going to happen. They'll say, well, Bitcoin is going to do this and Ethereum is going to do that. And yeah, I think it's safe to say that over the long haul, the market is going as a general trend up and to the right. Yes, there's bull markets, bear markets, cycles, all this kind of stuff. But over the long haul, decades, we're looking at long-term growth up and to the right. But in the short term, there are multiple possibilities. So hedging means we set ourselves up so that no matter what happens, we win. Okay, what do I mean by that? Well, you make money no matter what. And the way that we do this, because obviously that sounds too good to be true, but the way that we do this is position ourselves to become a liquidity provider, and that allows us to participate in collecting a portion of the trading fees that are generated online every single day, 24/7, because the crypto market never closes. Now, as we get further along, I am going to show you a very quick little demo, like click by click. This is how you do this. This is how you set the things up. That's the tactics, okay? Everybody wants the tactics right away. They want to jump straight to it, but we have to understand the context that we're operating in, and we have to understand the overall strategy as well. So when I say collecting trading fees by becoming a liquidity provider, everybody who, if you're new to this, your brain first goes like, what? number one, I didn't know that was even a possibility. But number two, like, what do you mean? How does that even work? So let's take an example here. Okay. Coinbase, this is what we refer to as a centralized exchange. Okay. CEX. As opposed to there are online, there are many decentralized exchanges, what we refer to as a DEX. Okay, and Uniswap is just one example of a DEX. It is currently the largest, most reliable, most well-known DEX, decentralized exchange, that is available to us. Now, Coinbase, they operate more, and Coinbase.com, they operate more like a bank or a brokerage at this point, meaning they're not like truly a decentralized platform. They operate with DeFi and crypto assets, but they're not truly a decentralized exchange platform. So what that means is if you trade on Coinbase, you're just average Joe retail trader, you are going to pay some fees when you trade on their platform. And that makes sense because they paid a lot of money and they employ a lot of staff and they need to make money too. And one of their primary profit pathways is to charge trading fees. However, they'll typically charge 1% or more on every single transaction. So if I trade $10,000 worth of a thing, well, I'm paying $100. And on the surface level, you go like, oh, $100, it's not that. No, it's 1%. That's pretty high for, swapping ETH for USDC or something like that. Like the fees can really, really add up, especially if you're doing a high amount of trade volume. Whereas on a DEX, a decentralized exchange platform, yes, there are still trading fees. There's usually like gas fees, trading fees, and they all get bundled together to say, like, hey, this is what you're going to pay in order to make this transaction happen. These can range anywhere from 0.01% to 0.3% to 0.5%. And yes, in some cases, 1% all the way up to maybe even 3%, usually on the more exotic, is what they call them, the more exotic assets, meaning like the silly kitty doggy froggy coins, the fart coins, this kind of stuff that are much more lower cap. And people are looking for the quick hit, right? They're looking for the 50x and the 30x and whatever else. So it's much pricier to trade those kinds of assets. But the point of all this to say is on a centralized exchange in Coinbase, the company, Coinbase, they collect and they keep 100% of all of the transaction fees that are processed on their platform. Versus with a DEX, for example, Uniswap, they pay a portion of trading fees to all the individual humans that are providing liquidity to their liquidity pools. So if I'm on Uniswap and I'm going to say, all right, here's my liquidity pool. Looks beautiful. My liquidity pool has Ethereum inside of it, and my liquidity pool also has USDC. Okay, this is a very popular pair. I want to trade ETH for stablecoin, stablecoin for ETH. It happens all the time, literally hundreds of millions of dollars every day in transaction volume across multiple platforms, multiple networks. Very popular pair. So anytime someone, little trader, Mr. Trader here, comes along and says, hey, I want some ETH. Well, to get ETH out of this liquidity pool, you're going to have to put USDC in. So this guy goes, all right, I'm going to put in some USDC. I'm going to pull out some ETH, and I'm happy because I made my trade. So this guy over here, all he wants is to acquire ETH, and that's what he has done. But Uniswap as a platform goes, hey, we want more trade volume on our decentralized exchange platform. How do we accomplish that? Well, we make our trading platform safer, faster, more reliable for retail traders, advanced traders, for trading bots, whoever's trading in their liquidity pool. They want to make it deeper so that it's more reliable and it doesn't upset the balance. So if you think of like literally a pool, like a kiddie pool as a metaphor, if you got a tiny little kiddie pool with a few gallons of water in it, you throw a rock in there, it upsets the whole balance in the pool. But if you have an Olympic-sized swimming pool, you can throw a big rock in there and there's some ripples, but it kind of settles down and it's fine. That's what we're looking at here. With liquidity pools that facilitate transactions in the world of decentralized finance, the deeper the liquidity, the more stable and more reliable that pool is. So Uniswap goes, hey, we want more people trading on our platform. How do we make our platform super awesome and tradable? Well, we have lots and lots of liquidity across hundreds, if not thousands, of different assets and different pairs. Anything that's tradable has a liquidity pair that can be traded, swapped one for the other. So this other person over here comes along and says, well, I want to put ETH into the pool and I want to take USDC out of the pool. Great. Now I'm happy too. Now multiply this by literally millions and millions and millions and millions of people and trades happening all the time. Every single one of these transactions generates a small trading fee. And in the case of USDC, it is probably pretty small. It's probably 0.01 or even 0.05%, just depending on the nature of the pool and the fee tier. So then, because there's millions and millions of these, all of these tiny little transaction fees really, really add up. And so Uniswap, like I said, they want their platform to be reliable. So they say, how do we incentivize people to put liquidity onto our platform that we can utilize in order to facilitate these trades? So they do that by saying, hey, if you become a liquidity provider on our platform, we will pay you a portion of the trading fees that are generated. Now, this is a key concept, especially if you're newer to this, okay? You got to understand, you are getting compensated because you are providing actual real value to someone else's trading platform, okay? And that's critical to understand because most of crypto, and I've been in this a while, I know most of crypto is money out of thin air, like one, zero-sum game. One guy loses, one guy wins. So it's very much that rather than playing the game of like swapping meme coins, get in, get out quickly, high stress, high maintenance, we're saying, you know what? Let me just position myself strategically so that I can set it up, and then I'm just going to sit back and relax and collect trading fees because they are being produced every minute of every day. Crypto markets open, like I said, 24/7. So every time a transaction happens of the pair that you're participating in as a liquidity provider, you get paid a portion of those fees. So if this giant pool here, and I'm just going to use big round numbers to make the math easy. This is obviously just an illustration. If this giant pool has $1 million in liquidity, or what they call TVL, total value locked, okay, that's the amount of liquidity. And with ETH and USDC, the total dollar value, let's just pretend it's exactly $1 million. And let's say you come along and you want to be a liquidity provider in that pool and you provide $10,000 worth of liquidity. Well, that is 1% of the total pool. So you will get paid 1% of the total transaction fees that are generated in that pool every single day. So if the pool generates, and again, I'm just making up numbers for the sake of simplicity, let's say that pool generates $50,000 total in trading fees. Well, you don't get all of that. You get paid in accordance with the percentage of liquidity that you're providing. So in this example, you would get paid $500 because that's 1% of the total 50,000 that's generated. Now, these are nice, friendly, happy, round numbers. In the real world, everything fluctuates every single day, okay? But what we're seeing, and this is in my own personal portfolio, this is in the portfolios of folks in the mastermind, what we're seeing is even when you play it safe, even when you act conservatively, even when you're invested in the big large market cap, blue chip crypto assets, we are still seeing on average 50% to 100% APR. So what does that mean? It means when you get paid and you get paid in the assets you're providing. So in this example, you're not paid in dollars initially, you're paid in ETH and USDC. And USDC is pegged to the dollar, so it's a pretty good comparison. You get paid in ETH and USDC. And when you express that denominated in dollars as a dollar value, then that comes out to approximately 50% to 100% APR per year. Okay. So that's just trading fees. This does not account for the long-term growth and appreciation of the base assets. Okay. So ETH and USDC in this example, if I provide liquidity for a liquidity pool that is Ethereum and USDC, I am still exposed to the market price action of Ethereum and USDC. If I wanted to pair wrapped Bitcoin and Ethereum, I would still be exposed to the market action of both Ethereum and wrapped Bitcoin. What does that mean? It means you get to participate in trading fees plus growth or appreciation long-term of those base assets. So what we're saying here is, hey, you want to be in crypto and you go, I got a buy and hold strategy. That's actually a good strategy, okay? If you have the patience and the cojones to just like buy Bitcoin and sit on it for 20 years, do it. You're going to make money, okay? In all likelihood, you're probably going to make a lot of money. But while you're holding those assets, Ethereum, Solana, BNB, AVAX, whatever those assets are, as long as you're going to hold those anyway, why not put them to work and create a productive asset rather than a non-productive asset? Okay, this is another key concept. And this is not a new concept. It's not like this started with decentralized finance. We're just applying these principles from the financial sector to the new emerging world of decentralized finance. So an easy example of productive versus non-productive, well, a non-productive asset would be gold. I buy a brick of gold and it sits there, and 40 years later, it's still a brick of gold. Now, it may have gone up in value when denominated in dollars, but typically with gold, you're basically just hedging against inflation at that point. Like it goes up in dollar value, but then the purchasing power of your dollar has diminished so much in the meantime that you basically broke even, but you did preserve your capital, which would be a lot better than keeping it in cash where it just slowly diminishes over time. So on the flip side, a productive asset would be something like real estate. Okay. And this is a great metaphor, a great comparison to what's going on with being a liquidity provider. All right. So I say, hey, I'm going to buy a piece of property. And this piece of property is, let's just call it 1 million. Okay. I'm going to hold that piece of property for 10 years. And oh, look, it went up to $2 million. That is the appreciation of the base asset. So remember, we talked about trading fees plus growth, appreciation of base assets. So I made money there, or I made dollars, I should say. But while I'm holding that piece of real estate, that asset for 10 years, I might as well rent it out. And I can make, gosh, I don't know, on a $1 million house, what's monthly rent now? 4,500, 5,000? I don't know. I can make monthly rental fees on that property. So it is productive, meaning it's a thing that has value in and of itself, but it also produces something else of value. So if we take this metaphor and we apply it to the world of decentralized finance, we go, gosh, I want to buy Solana. I want to buy Sol. Okay. I could sit on my Sol and wait 10 years and I made some money because it went up to, I don't know, let's say it went up to 2,000 over the course of 10 years. So now every Solana token I own is worth $2,000. I'm going to sell it. I'm going to make money. That's great. There's nothing wrong with that. But what if I could add, and in the case of Solana, I said 50 to 100% on average. With the case of Solana, I'm actually getting 112% per year on average. And some people who are playing even tighter ranges are getting more than that. Okay. So as long as I'm going to hold the Solana for 10 years, why not also add 112% per year? Now, 100% a year is doubling your money. Okay. So that would be 2x. If I double my money, and even if I only compound once a year, 2x becomes 4x, becomes 8x, becomes 16, becomes 32, becomes 64, becomes 120. You can see this is only 1, 2, 3, 4, 5, 6. That's only 7 years. Okay. It keeps going. 256. So the returns get ludicrous when you talk about like doubling your money every year. Okay. And again, these are not guarantees of returns. We're all adults. We understand this. This is an illustration. I'm modeling out how this can potentially work with the numbers, okay, that we're seeing right now currently in the mastermind. So I have my Solana. I'm getting my 112% per year APR. And in the case of Solana and USDC, I'm getting paid in Solana and USDC. Well, along the way, guess what? The extra SOL that I'm getting is also going to go up in value. And if I wanted to, I could swap the USDC for more SOL, and I'm just stockpiling SOL, stock. I can compound it back into the base pair, or I can hold it unpaired in a separate wallet. The point is, I'm getting not just appreciation of based assets. I'm getting not just trading fees. I'm also getting the next layer, which is the growth and appreciation of those trading fees. So here's what this looks like if I modeled it out just very simply. I would say, okay, here's number one. Here's my base. This is my pair. Okay, I'm gonna be a liquidity provider. That process produces for me a yield in the form of trading fees that are generated. And that will be, in this example, SOL plus USDC. Then I take those trading fees, I swap them for whatever I want, and let's just say all I want is Solana for some reason. That's fine. I'm just going to get more SOL. Then I can either set this aside and just hold it. Okay. Or I'm going to bring it back over here and I'm going to add to my base pair. Okay. There's two pathways, two different models of compounding. Both are good, both are profitable. Okay. So this is not a thing where I say you have to do one or the other. One's better. They're both great. They both make you a lot of money. Okay. So let's go back to our farming metaphor. If I said, hey, I'm going to buy this piece of land, and this piece of land is 100 acres. And this piece of farmland produces potatoes. Yay, potatoes. Okay, there's all my potatoes. Now I'm going to go sell my potatoes and I'm going to make some dollars. Great. I could just keep those dollars. Nothing wrong with that. Or I could go buy, maybe I like corn. So I didn't grow corn, but I want to grow more corn because I think that everyone in China is going to want to buy my corn in 2 years. So I'm going to store it in a bin and it's going to go up in value and then I'm going to sell it 2 years later. So not only did I get the money, but because I converted it into another, in this case, commodity, but another thing that can also grow in value, then this even multiplies even more the return that I got. Or I could take this money and I'm going to put it back over here and I'm going to buy more land. So now I have 110 acres. And then on the next round, I'm going to produce even more potato. Okay. Then I'm going to sell all those potatoes for money. Then I'm going to compound it again. And then the next year, I have 125 acres. You get the idea. So the farm metaphor is basically just saying you have a thing, an asset that produces something. After you produce that thing, you can then turn that into something else. You can compound it or you can sell it for something else that will also grow in value over time. All right. So if we were going to do this in the world of decentralized finance, I'm going to give you just one example. And this is the example that I'm going to show you the click-by-click tutorial for. Okay. So I've got Solana. I've got USDC. I'm going to pair these together. I'm going to create some LP. I'm a liquidity provider. And I'm going to drop it into this liquidity pool right here. So I've taken these two assets, mashed them together. They are now what's called a liquidity position. Liquidity. And again, core concept. Hedging, productive assets, liquidity position, okay? I create my liquidity position. Now, I'm just going to leave it there. Then all my traders come along. Maybe one of them's a bot. Maybe it's some people, whatever the case. And they are just wanting to trade. So they throw in SOL or USDC. They pull out SOL or USDC, depending on which transaction they're happening. And they just go around and around and around and around and around. And this is going to be on a daily basis with this example. This is going to be literally hundreds of millions in trade volume. Okay. Trade volume. Now, I checked earlier today, and it's not quite at 100% today. That's okay, because the trade volume fluctuates on a daily basis. So some days you'll get 200% APR. So it's just expressing the APR. It's basically saying, hey, if you got today's return every day for 365 days, this is what your final year-end APR would be. So it'll tell you some days, 250%. And the next day it'll be like 180%. And the next day it'll be 70%. And you go like, it's going down. No, it's just because less trade volume happened that day. And then the next week it goes up again, and then it goes down, and then it goes up again, and then it goes down. So the trade volume on a daily basis fluctuates, but that's okay, because over time, in this example particularly, we're seeing 112% APR just on the fees alone. Okay. So there was a period of time, and I forget the exact dates now off the top of my head, but there's a period of time I looked at my SOL USDC position and I realized, oh my word, today's value of Solana, I think it was like 180 something at the time, or somewhere around there. If you go back exactly 1 year, it was the exact same value. Meaning from the day I looked, which was a couple months ago now, but from the day that I checked this, if I had bought Solana a year ago and just held Solana, I would have broken even, meaning like nothing happened. It's just me sitting there for a year, no gain, no loss. So I didn't lose, but I didn't really get anything, right? But because I had been participating as a liquidity provider that entire time, my position grew by 112%. So in this case, I compounded it back into the pair and kept going, rinse and repeat, right? So I'm going to become a liquidity provider here. I'm going to put my SOL USDC in there. This is going to create for me a yield, and that yield is going to be paid to me in Solana, and it's going to be paid to me in USDC. Okay. Now I have options. Like I said, I just compounded mine. You can do that. Or you could say, well, I'm going to trade this USDC for more Solana, and then I'm going to put this over here in a separate wallet, and I'm just going to sit on it, and I'm going to wait, because we are approaching what is, in all likelihood, based on previous 4-year cycles in the crypto market, we are approaching the next massive final leg up of the bull run. How long is that going to last? No one knows for sure. Everybody says they do, but no one knows for sure. It could be 3 months, it could be 6 months, it could be 8. I don't know. Okay. I don't know the exact time frame, but the point is, as long as you are positioning yourself to earn no matter what, back to the beginning, you are hedged. Okay. This is the core concept for this entire masterclass. Okay. Most people are chasing what they perceive to be, and that's important, it's what they perceive to be the maximum possible. They're chasing what they perceive to be the maximum possible upside. What does that mean? They say, well, I think if I just hold Solana, I can get a 8x or whatever, like pick a number, right? People are just going, I don't know. Problem is, we only know in retrospect what the actual tippy top of any market cycle is. We don't know it ahead of time. So when we look backwards in time, that's actually a really terrible way to then make decisions about what's happening in the future. Because number one, markets will not always act the same as they did in the past. They will often, mimic or echo in a loose way what happened in the past, general trends, but almost never do they exactly imitate what happened in the past. So if you're chasing what you perceive to be maximum possible upside, you expose yourself to unnecessary risk and you will drive yourself crazy. Okay. The alternative is to say, rather than chasing more, maximum possible upside, all I want to do is every day, incrementally, get closer and closer and closer to more of what I want. Okay. And yes, in this case, it's a dollar value, probably, but then you exchange the dollars for what you actually want, because no one just wants dollars, right? We want dollars for the things that we are that we value, that we want to buy with them. Could be a home, could be a car, could be vacations, could be savings, could be security, whatever the case may be. We want to get closer and closer to what we want versus just saying more. All right. Put this into perspective. Most traditional asset classes will yield you 8 to 12% per year. Okay. So even if all you got, split the difference, 50 to 100%, let's say, even if all you got was the 75% per year, you are wildly outperforming pretty much every human on the planet, except for those who are also in DeFi. But you're outperforming by a factor of, 6 to 8x just by playing it safe. Okay. And in by crypto standards, aiming for 75% a year is extremely conservative and safe. Like you can play in the blue chip space only. You don't have to chase kitty doggy froggy hippo coins. And you can just rest assured you can sleep easy at night knowing like, hey, I'm doing good to go. So what happens, and I see this all the time, is people will get a return and they'll go, wow, this return is great. I want more of that return. So they get their 2x for the year and then they go, let me push. Let me try the next meme coin. Let me click more buttons, right? The number one question I get, even in the mastermind, is, okay, Brandon, it's set up. Everything's working. I'm getting 120% APR or whatever. Now, what else do I do? And it's like, no, don't do anything else. Like you already did it. Now your job is to have the patience to just sit tight. Okay. That's why the company's called the patient investor. Because once you get to the point where you're yielding on a regular basis, you're good to go. And yeah, you might study a few other assets and invest in a few other pairs. That's fine too. There's nothing wrong with that. It's just that this approach is designed to be low maintenance, meaning there's a learning curve. For sure, there's a learning curve. But once you get it set up, once you know what you're doing, you really don't have to dedicate more than 10 or 15 minutes per week. Now, some people like to do more, right? Some people love the game of crypto. They want to read about all the new stuff. That's fine. No big deal there. But I'm saying if you want something that is really low maintenance, I'm not saying passive because nothing's truly passive, but if you want something that is low maintenance, that is what this is. Okay. So let's pause there for a moment. I saw there were a few messages in the chat. Let me just quickly check these out. I have a pool. We'll come back to that one. What is the risk with LP? There we go. Okay, the risk. The risk for this method is equivalent to the risk of holding crypto unpaired just in a wallet. Okay, meaning if I am in a pair of Sol and USDC, the risk is equivalent as if I just held Solana and USDC. And USDC, it's like, well, it's pegged to the dollar. It's not going to fluctuate in value. If Paxos, the issuing company, blew up tomorrow, then yeah, maybe there's some risk there. But for the most part, USDC is all the risk is negligible. And then with Solana, you just go, hey, do I think Solana is going to fail in the next 10 years? Probably not. No one can say for sure. But it's like if I want to farm with Ethereum, then it's the equivalent risk of me just holding Ethereum. But if I want to try to farm with Fartcoin, and well, Fartcoin is maybe a bad example because it ended up doing all right. But there's a lot of other silly meme coins or shit coins, as they call them, that don't do very well. Okay. So if you try to play with those and be a liquidity provider for those, yes, the risk is exponentially higher, just as the risk of holding those unpaired is also exponentially higher. So what we're talking about here is not layering on additional risk. We're talking about taking the same amount of risk and layering on additional profit earning opportunities. I need to drive and might lose service. Crossing my fingers. Okay. Ken, what is the safest stable coin to pair with? Would it be USDT? So, Ken, there's not a safest stable coin. There are a few really good options. Currently, those good options are USDC, USDT, uh, BUSD, which is on the Binance network. And then more recently, USD1 has also come into play. Now, there's some other stable coins that are probably fine anyway, but for those four, you will find not only reliability, but you will also find the highest trade volume flowing through those. And ultimately, what we're looking for is that balance between TVL, which is total liquidity locked, TVL and trade volume. That ratio is the magic formula, meaning you want high trade volume, but you don't want a super shallow pool that like just came out yesterday. You want the tried and true combined with very, very high trade volume. So what I'm going to do now is take you through a click-by-click tutorial of setting up specifically a Sol USDC position. Now, when you watch this, you might think, oh gosh, that was super easy. Yeah, super easy because I'm just doing a tutorial. There are nuances and variables and other things involved. So I don't want to give the impression that it's like, hey, just go out and do this on your own. In fact, I would say if you're going to try this on your own, be super, super cautious if you've never done it before, because you can run into some trouble along the way. Okay. But let me pull this up. Get my whiteboard out of the way here. All right, there we go. Okay, so you should be able to see this. I'll zoom it in. This is a platform called Orca, okay? Just one of many, okay? It's not Uniswap, but Uniswap is one of many as well. They call this a liquidity management platform, meaning it aggregates data from a ton of different available pools and shows you what the estimated returns are. And I have found the estimated returns to be very accurate over time. So I'm going to click on pools and I'm going to take a look at all. I mean, you could scroll down, you can see just a ton of stuff available. We're not going to deal with everything today. We're just going to say, hey, If I'm going to come in here and trade only the most traded asset on this platform, it is Sol USDC. You can see the fee tier is 0.04%, and you can see that in a 24-hour, the most recent 24-hour period, there has been $202 million of trade volume just for that one pair, just for this one exchange platform, okay? TVL, total value locked, how much liquidity is being provided, 43 million. So when you see that, you go, gosh, if I put in 10,000, I'm going to be such a small, that's good. You don't want to be 80% of a liquidity pool. You want to be a fraction of a liquidity pool. So these are all good signs. I look at the fees from 24 hours, meaning in 24 hours, there have been $80,000 worth of trading fees generated in this pool. And I go, you know what? I want my cut of that $80,000 that is just flowing through this thing every single day. Now, take a look at this yield slash TVL return, okay? And this is a 24-hour return, meaning, whoops, sorry, I clicked into that too soon. Meaning I have to multiply this by 365 to get my yearly APR, okay? 0.27% is 100% APR. 0.185 times 365, that is 67.5%, okay? So this falls within my range, my ideal range of 50 to 100%, but you're probably thinking, Brandon, I thought you said you got 112 on Solana. Yes, that was actual return over the course of a 12-month period, meaning some days it's 0.185, 67% APR if we extrapolate it out for the whole year. Some days it'll say 0.25%. Some days it'll say 0.4%. I've seen Sol USDC as high as 0.7, 0.8% on a daily basis. So the fluctuations can and will be all over the place. That's normal, and that's just part of this process. So if I wanted to open a position here, I'm going to click on this, and let me move my lovely face off to the other side here. And this is going to give me options over here to create a position. Now, custom range, that's what I want. And it gives me by default a very, very tight range. Okay, basically in a nutshell, range just means the range inside of which you will collect trading fees. If I fall out of range, I will stop collecting trading fees. So given the fact that Solana fluctuates quite a bit, I don't want a super tight range at -2 and 2% from the current market rate. I'm going to just do 10% to either side. This is kind of like a general safe-ish range, okay? And then I look at my estimated yield and it's saying, wow, 0.434%. That's actually higher than I was expecting. And for me, I would rather have a wider range and be closer to the 100% APR than trying to chase a massively high APR. So I'm just going to pull my range out to 15% on the upside. And I'm going to actually do it even a little bit more. Let's go all the way to 20. All right, there we go. Looks good. So I've got -10% to the downside, 20% to the upside. My range is now about 138 to 183, and they're estimating about a 0.3% daily yield. So remember, 0.27 is 100% APR yearly, so a 0.3% daily will be just over 100% annually. All right, so that's a really good return. Now I can scroll down here, and in my little demo wallet, I'm pretty sure I only have Solana at the moment. Yeah, I basically just have some Solana here. So I'm going to do what they call the auto swap feature. And I'm going to click that on. Basically, it means I'm just going to contribute Sol, and it's going to swap a portion of that for the USDC for me in order to create the pair. So I come down here and I say, okay, I'm just going to do like a 0.1 here. So it lets me know, hey, your pair is going to be about $15 worth of Solana, $9 worth of USDC. That looks good. I'm going to click up, fetching a refreshed quote. Step one trade. Opens up my wallet. I can confirm all of this. Now, this, of course, assumes you've already got wallets set up and you got your security protocols in place. We skipped over that part because that's a little bit more involved. And then step two, deposit. Confirm that there. Confirming. Successfully deposited into Sol USDC. That was it. When I told you the click-by-click tutorial, if you blink, you miss it. No, but really, it really is that easy. And then I can come over here to portfolio, and it's going to show me oh, I just opened this one. Oh, I had another one demo from before. That's funny. Well, that one's doing really good too. That's great. Um, so I had forgotten I had that position open. That's funny. So it's gotten me already $12 on 57. So whatever that comes out to, a little 24% or something. So now this is the new position I just opened, the $24. My estimated yield is going to be 0.3%, and it's showing me the range that I have set up right there. And that's that. So once again, I will pause there. Let's do some questions. And the questions can be just in general, like, okay, how does this work? What's going on? Or they can be more like specific and tactical, or it can be more like big picture strategic considerations as well. And Raven had a question here. I have a pool set up with ARB and USDC. I looked at the TVL and volume on the pool, and it was very low. Me and another person were the only people in it. This sketched me out, so I joined a different LP with ARB and USDC, but now I'm not getting the best APY fees generated as the pool with very low TVL. Am I wrong to get sketched out about that? Should I have kept it in the pool? What's the downside to having it? Yeah, so Raven, this is exactly what I alluded to before, which is you do not want to be either the only liquidity provider or like one of two or three people that are in a pool. That would be a sketchy situation, even if the assets ARB and USDC are reputable. Number one, you just don't want to be in a pool where you're the only person in the pool. But number two, it sounds like it could be not those assets. As silly as that sounds, there are people who create assets that the little ticker, the ARB, looks like a blue chip crypto, but it's actually a completely random asset. And by getting into that pool, you're granting permission to potentially malicious smart contracts that could potentially drain your wallet. Okay. I don't know if that's the case here because I haven't actually looked at it to see what's up, but it would be very rare and weird for a pool with Arbitrum and USDC to have very low TVL, unless you're playing around on like some random new network. But if you were on the Arbitrum network or on Ethereum network, then those larger blue chip, larger market cap assets, they typically will always have very large TVL. And those are the ones that you want to participate in. Solid TVL plus very high trade volume. So in our example, Sol USDC, 43 million in TVL, over 200 million in daily trade volume. That's a good pool. I mean, they don't all have to be those exact numbers, but that's an example of a really stable, strong pool that you can make a lot of money in. Can you recommend several highly correlated crypto pairs that would return? I've been trying blue chip, but don't like them so much because of the extreme volatility of the market. Keeps putting me out of range. I don't know what's up. Okay, so Ken, this is a funny question. Okay, so number one, you're saying I want to get into correlated pairs, which is a separate topic altogether. But then you're saying I don't like the stablecoin pairs because they're volatile. So you're contradicting yourself, even though you might not realize it yet, and that's okay. Like that's obviously why you ask a question like this. Two assets where neither one is a stable coin, even if they are correlated, the correlation typically takes place over a larger time frame. So they'll never move, like you'll never get perfectly correlated assets. I mean, Bitcoin and ETH is about as correlated as you can get, and you can see there's still massive discrepancies. If you look at the chart with price action between Bitcoin and ETH, it all does its crazy thing too. So what I'm getting at here is two correlated assets where neither one is a stable coin. They will be more volatile in terms of where you move on the range. So your question, basically you're saying, hey, I don't like the extreme volatility. I keep falling out of range. The actual answer to that is widen your range. Okay. And that's not the only, like, there's more to it than that, but just as like for a session like this in the group with just general parameters, widen your range. And yes, your APR will go down, but you will solve the problem of falling out of range more frequently. Greg, how do you track your investment portfolio for tracking purposes or even tax? I use Coinly now. Would that work accurately? Yes, Greg, Coinly is a great product. None of those tax prep things are 100% accurate yet, but Coinly at this stage is probably the least bad of the options that are available to you. So coinly.io is a great tracker for the purposes of tax, tracking for taxation and filing taxes. And then other trackers, I mean, there's a bunch of them out there. I mean, there's Zerion.io, there's Zen Ledger, there's, oh, what is it called? Is it Coin Tracker? The Coin Tracker is one, but there's another one. I just can't think of it off the top of my head. I have a list of them somewhere. But yes, there are plenty of tracker softwares out there because what happens, especially when you get into opening positions, closing positions, rebalancing positions, there's no way you could, well, I guess you could track it manually. It's just the thought of tracking all this manually would make my head explode. So you definitely want to use one of those coin tracking softwares to keep track of all of this. When your position is at the upside, so position at 200, what do you do? Just wait until a dip and get back in or create a new range on the upside? Yeah, so I think, Raven, I think what you're asking is what happens if I go out of range? And there's a few options at that point. It's not like a one size fits all approach. It depends on what's going on in the market. It depends on if you anticipate a retrace. So, for example, I was in a Sol USDC position a while back where it went out of range on the upside, but the reason it went out of range is because Sol spiked very, very quickly. And the reason it spiked very, very quickly is because of the mania when the Trump and Melania coins came out on the Solana network. So I put two and two together. I was like, oh, everybody's buying more Solana just so they can buy the meme coins because the meme coins are only paired with Solana. So you have to have Solana to buy the meme coins. So I could tell this was an anomalous spike in price because of the massive trade volume. I anticipate that it will immediately in the next couple days come back down and I'll be in range again. Lo and behold, that's exactly what happened. So you either wait, which typically that's a good idea to just wait a few days and see if you come back in range. If you're not coming back in range and you anticipate that it's going to keep going in the same direction, you either rebalance your existing position, or if you're in it for the long haul, you just open a new position and you leave the old position there and you go, at some point, it's probably going to come back down. Might be 6 months from now. But if you have the patience to just say, I don't really need that capital immediately, so I'm just going to leave it there, it'll come back in range and it'll start generating trading fees again for you. So this is not a thing where you just open one position and that's the only position you open. You do have an option to open multiple positions of the same asset pair across different range categories. Do, 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 do. Do you recommend transferring your crypto into a non-guarantor irrevocable trust for protection and tax benefits? I don't make recommendations on that kind of stuff one way or the other. That depends on your personal financial situation and what you're hoping to accomplish. But what I can tell you is that it is possible to create either a trust or a separate LLC or various other legal entity types and to store your crypto under those entities. And typically, the benefits would be either for taxation purposes or if you are wanting to transfer ownership of those asset holdings to someone else. I'm not the tax professional. I'm not the legal trust creator professional. I just know that it is possible, and we do have multiple people inside of the mastermind who opt in for different type of legal entity structures to hold and invest in crypto. What are the risks of losing the initial capital into these pools? How do you mitigate those risks? You won't lose your initial capital unless one or both of the assets in the pool completely tanks. So if I invest in some silly, stupid new Hippo coin and the Hippo coin loses 98% of its value, yeah, my pair is also going to suffer because of that. But if I'm invested in pairs like Solana and Ethereum and anything on the blue chip side, the likelihood of that happening is so much lower that it is, in my opinion, almost negligible. So again, back to our premise from before, the risks are equivalent to holding crypto unpaired. To which I would say, if you're uncomfortable holding crypto in general, you definitely should not be doing liquidity pools. Liquidity pools are for people who already have a strong belief in the crypto market in general. And if they weren't doing liquidity pools, they would likely just be buying and holding over the course of the long haul anyway. Or someone who's interested in getting started in holding crypto and participating in liquidity pools. So yeah, I think that's it. Okay. So here's the thing. Obviously, we have a mastermind, and there's a few people here, I think, actually, who are in the mastermind. I see a few names that I recognize. It depends on how reputable the pool is. I would imagine some of these pools which have been, yeah, exactly. Y Surd, whatever your name is. That's correct. We do have a mastermind, and the idea is if you want to participate in this process, but you want to do it in an environment where not only do you have other people around you, there's over 300 members right now in the mastermind, but you also get a one-on-one mentor slash coach assigned to you. So if you want someone to guide you through the whole process click by click, you jump on Zoom calls with them, you share screen, they show you exactly what to do and how to do it. If you want to be cautious and set up your security protocols so you don't get your wallets drained. And I know it sounds like, oh, that'll never happen to me. Like literally every week, I hear stories from people who haven't joined the mastermind yet about getting scammed, about wallets getting drained, about all kinds of nightmare stuff you couldn't imagine. In fact, just the other day, I talked to a guy that I originally talked to 2 years ago, and he didn't join 2 years ago. And he then told me that in the meantime, he's lost over 70,000 to a scam, like a legit scam. He didn't just invest poorly. Someone scammed him out of this 70 grand. So now he's reconsidering joining the mastermind, which obviously I'm biased, but I think that's a great idea. Like if the problem with getting scammed primarily is because you don't know what scams look like, or you think you do, but you don't, then the safeguard against that is to be in a community and have mentors who can tell you with 100% certainty, yes, that is a scam. Don't click on that button. If you click on that button, you're going to lose all your money. If you click on this button over here, you're going to get 112% APR on Solana USDC per year, plus the growth and appreciation of those assets. So that's not the only benefit of the mastermind. It's just that that's one of the biggest considerations. What's the first rule of investing? Don't lose money. What's the second rule? See rule one. And again, back to the principle of hedging, most people are chasing higher and higher returns when what they should be chasing, in my opinion, is a strategic and hedged strategy, as well as a system and a community that holds you accountable to implementing that strategy gradually over time. So all that to say, I'm going to put a link in the chat here. The link is an application. Okay, really short application. It'll take you like 2.5 minutes. There it is right there. So in the chat, investormastermind.com/learn. And then there's a big green button. I'll show you. Right here. Video of my beautiful face and a large green button. Click here to apply. You click on the green button, fill out the short application, and then you'll be redirected to a booking page. Okay. You will speak to either myself or you'll speak to one of my advisors, Paul. Okay. So we're trying to get as many available slots as we could on the calendar, but you'll speak with one of us. Obviously, just if it was just one of us, we wouldn't be able to handle the volume of calls that come in, but it could be me, it could be Paul. And it's a chance to just meet with someone one-on-one. We'll ask you to share a little bit about your crypto journey so far. Obviously, we need some context of what you might need help with. And we'll talk about how you would implement what I just showed you. So, okay, Brandon, great. You drew a nice little diagram on the whiteboard. Looks good conceptually, but you go, what does that mean for me? Like, how would I actually put this into play in order to multiply the profits from my crypto holdings? That's what we're going to walk you through, okay? And then we'll also open that up for a little bit of Q&A if you're still unclear on some of the details, especially if this is the first time or even the second time that you've heard this stuff. It doesn't always sink in right away. I mean, it took me years to get a hold of this kind of stuff. And I'm still growing and evolving. And there's new tools and new tactics and new stuff being produced every day. It's crypto. It's a brand new emerging technology. So we'll kind of work through any questions you might have, any points of clarity that you want to figure out on this journey, and we'll take a look at if Mastermind membership is going to be appropriate for you at this stage. And if it is, we might invite you to join the Mastermind. Simple as that. Okay. There's never any pressure from our side. We don't do the grilled down hardcore selling, whatever. It's literally just, let's talk, tell us about what's going on. Here's the answers to your questions. And then, you can make a decision if this is the most appropriate path for you based on your needs, based on your long-term investing goals. I do want to emphasize this is not a make a bunch of money in the next 6 months kind of an approach. This is if you want to set yourself up for the long haul, this is the most hedged play that you can still make an incredible return, especially compared to traditional asset classes. Daryl, is the risk of being hacked the same as holding crypto? No, they're different. So holding crypto, if you, for example, if you're just buying and holding, as long as you have your seed phrases written down, stored in a secure location, not online, stored in a secure location, and you don't share those with anybody, and as long as you add the layer of security by using a cold wallet, like a Ledger or a Trezor, you're actually not at risk of getting hacked. The only way you could get hacked with that scenario is if you willingly gave your seed phrase to someone or you willingly granted permissions to a malicious smart contract. But if you know where to click and where not to click, you won't do that. So that's part of the benefit of being in a community is like, hey, Brandon, this looks funny. Should I click here? No, don't click on that at all. And like I said, I've seen every week I talk to someone who's clicked on a link that they shouldn't have clicked on, and it's set in motion a cascade of things that I don't know if I'd call it a hack. It was basically just like they unwittingly gave permission to someone else to take all their stuff. Because that's the nature of smart contracts is you grant permission for them to interact with your wallet address. All right, we're done for today in terms of the content I had planned for our session today. Like I said, if you'd like to explore membership in the mastermind, click on that link, fill out the short application, book a call with us. And then otherwise, you can continue to follow along in the Facebook group is a great place to do that. I know some of you came from the Web3 Syndicate group. I'm not like super active in that group. It's not my group. I got permission from Peter Voog to post about this session. But the Facebook group is going to be probably the best place to stay connected to the source. And then I recently just started publishing on Substack. And Substack is, hey, here's just some helpful knowledge and training about the crypto market and about specifically becoming a liquidity provider. Otherwise, if there's no other questions, I'll give you a little bit of your time back for this evening. If you want to stick around, ask a question, chat for a little bit, I will also stick around for a few more minutes. But officially, that's the end of the planned session for today. So thanks everyone for joining us.